Why most traders fade value extremes too early. Most traders do not lose fading value extremes because the idea is wrong. They lose because the timing is wrong. They see price pushing above value or flushing below value, and they immediately assume the move is overextended. They try to sell the high or buy the low before the market has actually shown any evidence of a rejection. And that mistake can be expensive because a value extreme is not automatically a reversal zone. It is simply a place where the market is testing whether it wants to keep doing business there. And that distinction matters. If you fade too early, you are not trading rejection, you are trading an opinion. And in auction markets, opinion is weak and confirmation is what truly matters. Today, I want to break down why traders keep fading value extremes too early, what professionals look for instead, and how this changes your entry, your invalidation, and your target selection. First, let's get a clear concept. At a value area extreme, whether it is the VAH or VAL, it is not a magical turning point. It is simply a structural reference point. It tells us where price is moving away from fair value and into a potential area of excess, acceptance, or value migration. But price can do one of two things at that extreme. It can reject the area and rotate back through value, or it can accept above or below it and begin repricing. That is the whole game. The problem is that most traders treat value extremes like automatic reversal levels. They think price is above VAH, so I should short, or price is below VAL, so I should buy. But that skips the most important question in the entire trade. Is the market rejecting the extreme, or is it building acceptance there? Without that answer, fading the extreme is just guessing. This is where retail traders get trapped. They confuse location with signal. Now, location does matter. In fact, trade location matters more than the trade idea itself. A bad trade at a bad location is obvious, but a lot of traders take that truth too far. They find a good location and assume that alone is enough to act. It is not. A value extreme is a good location to pay close attention to. It is not a good location to blindly execute. Professionals understand that the edge is not an extreme alone. The edge comes from combination of structural location, participant behavior, and confirmation. That means when price pushes into VAH or above it, the question is not, can I short here? The real question is, what is the market doing here? Is there aggressive buying that cannot continue higher? Is there absorption at the offer? Is there a failed auction above the extreme? Is delta pushing up while price stalls? Is the market quickly reclaiming the value area after a probe? Or is price holding above value, building time there, and showing that buyers are comfortable doing business higher? Those are two completely different conditions. One supports a fade, the other supports continuation. And if you cannot distinguish the two, you will keep fading value extremes too early. Let's make this practical. Imagine NQ opens inside value and later rallies into prior day VAH. A lot of traders will see first touch of VAH and immediately sell. Why is this? Because they have been taught that value area high is resistance, but that is incomplete. If price tags VAH and keeps rotating in a tight, controlled way above it, holds VWAP support, and starts printing volume above the edge, that is not clean rejection. That is a potential acceptance. If initiative buyers are active and responsive sellers are not pushing price back into value, then the market may be advertising a higher price. Shorting there is not disciplined. It is too early. On the other hand, suppose price pushes above VAH, attracts breakout buyers, stalls, fails to extend, shows some absorption, and then quickly re-enters value. Now you have something very different. Now the market has tested higher prices and failed to find continued acceptance there. That failed auction creates asymmetry. Why? Because your invalidation becomes structural. If the rejection is real, price should not comfortably re-accept above the failed probe. That gives you a clean line in the sand, and your target is logical too. Rotation back through value, potentially toward POC, VWAP, or the other opposite side of value, depending on the context. That is what a professional fade looks like. Not prediction, confirmation. The same logic applies to VAL. And Q flushes below value. Everyone starts calling it oversold, and traders rush to buy the low. But below value does not mean cheap. It means the market is testing lower prices. Sometimes that test fails and price rotates higher, and sometimes value is migrating lower and the market is simply in price discovery. If you buy too early beneath VAL without evidence of exhaustion or rejection, you are stepping in front of an initiative pressure. That is one of the easiest ways to get trapped in a one time frame move lower. This is why so many traders feel like the level was right, but the trade still lost, because they were right about location and wrong about process. That is an important lesson. Being early is often the same as being wrong. Now let's talk about the core misunderstanding beneath all of this. Most traders want the best price. Professionals want the best trade. They are not the same thing. The trader who sells the exact high or buys the exact low feels smart for a moment, but that entry often comes with weak confirmation, poor information, and emotional reasoning. The professional is willing to let the market prove rejection first, even if it means entering slightly worse, because the trade is now built on evidence rather than hope. That usually improves the one thing that matters most over time, decision quality. And decision quality drives survival. In the Trading on the Edge framework, this is a major principle. Edge does not come from calling the turn. It comes from identifying structural asymmetry with clean invalidation. A value extreme only becomes tradable when the market reveals whether the auction is being rejected or accepted. Until then, patience is not passive. Patience is part of execution. Here are the common mistakes traders make when fading value extremes too early. First, they short above VAH or buy below VAL with no reclaim, no stall, and no shift in behavior. Second, they ignore context. A value extreme inside a balanced session is different from a value extreme during trend day conditions or after value migration. Third, they use tight, arbitrary stops instead of structural invalidation. So even when the idea is eventually right, they get taken out because the trade was placed before the market confirmed anything. And fourth, they target too much while confirming too little. They want a full rotation trade from a weak entry. That is backwards. The better framework is simple. Start with the value extreme as an area of interest, not an automatic setup. Then ask whether the market is showing acceptance or rejection. Look for failed auction behavior, absorption, inability to continue, reclaim of the edge, and evidence that initiative activity is losing control. Then define invalidation structurally. Then aim for logical target magnets inside the auction, not fantasy reversals with no context. That is how fading becomes low variance instead of emotional. So the next time price reaches a value extreme, stop asking whether it is high enough to sell or low enough to buy. Ask whether the market is actually rejecting that area. Because most traders fade too early for one reason. They act on location before they get confirmation. And that is exactly why they keep getting trapped. If this is how you want to learn the market through structure, value, acceptance, rejection, and execution, subscribe and keep building the framework with the channel. And if you want the full operating model behind these lessons, Trading on the Edge is a deeper resource. It is built to work alongside the free content here, so you can learn these concepts into a real execution process without paying for an expensive futures course. Thank you, and I'll see you in the next one.